Good evening, students. I hope you have revised what we have discussed in the last class. So, we are going to continue there from only. So, last time, yesterday, we stopped at the taxation in respect of the sports person, right? Now, we are going to start with the TDS provisions which are applicable to the non resident. In this particular class, we'll go to the DT relief and we'll discuss about the Finance Act amendments and your September amendments that for your September attempt, whatever will be applicable. But before that, one more important case that I would like to discuss in relation to the last topic that we had closed on with respect to non-resident sports person is the question of whether the match referees and umpires who are non-resident would fall within the sportsman definition as to attract 115 BAA. So, in that respect, the Calcutta High Court in INCOM has held that the non-resident match referees and umpires which are there, uh, these can be described as the technical person or professionals who are rendering these kind of professional person, but they are not sportsmen or athlete, right? So these would not be taxable under 115 BAA. This would be the TDS also will not be applicable under 194E. The TDS in fact will be applicable under 195. So this is one important case that we wanted to discuss. Next case is regarding the Board of Control for Cricket in Sri Lanka and Pilcom versus DIT and Pilcom versus CIT. This case which is there. So in this particular case, there was the guarantee money which was paid to the Board of Cricket, right? Now the question was that whether the non-resident sports association which had participated in the cricket event where the cricket teams of these association had played the games in the different countries. Now, in respect of that, some guarantee money was paid. So, whether this would be taxable under 115 BBA. So, the answer was the Supreme Court examined and said that there is a connection between the guarantee money paid to the sports association and the sports association's cricket team which had participated in the event, right? So the source of income was basically the playing of the matches in India. And therefore, 115 BBA will be applicable on this particular point also. Are we clear? Now coming to the TDS provisions, the first one is 194 LB, which is the income by way of infrastructure debt fund. If you remember in the last class, we were discussing about the interest which is taxable, right? If you remember, I told you as far as the taxability of the interest is concerned, we have the general rate of 20%, which is under 115A, isn't it? But I told you that in respect of the infrastructure debt fund, interest on infrastructure debt fund, it will be taxable at 5%. And therefore, LB at the rate of 5%. Are we clear? So that's a small point. The second one is income by way of interest from an Indian company or a business trust on which the TDS is applicable under 194 LC. Now, as far as the 194 LC is concerned, this is only applicable where the loan agreement is made before 30th June 2023. So, usually interest is taxable at 20%. But in case the agreement is before 30th June and it is by way of the long-term infrastructure bond, the borrowings are made in foreign currency, or it is the rupee denominated bond which is issued before 30th June 2023, in those cases the TDS will be applicable under 194 LC, which is at the rate of 5%. So after that, this particular provision is not there. It is on this 194 LC is only applicable in respect of the interest paid by the IFSC unit, in which case it is 9%. Are we clear? Next is non-applicability of higher rate of TDS under 206AA. What is section 206AA? 206AA says that if you do not furnish the PAN, the TDS will be deducted at a higher rate, isn't it? So higher rate would be the higher of the rates under the Act or the treaty. and 20%, right? So the 206AA
20%.
will be saying that the higher will be rate prescribed in the act, rates in force, or the 20% rate, right? Now this says that in the absence of PAN, the 206AA will not be applicable in respect of the 194 LC also. So 206AA, if you do not furnish the PAN, would not be attracted in respect of the interest on the long-term bonds, which are referred to in 206AA. Also, even in other cases as well, if you furnish these details, Rule 37 BC provides that 206AA will not be applicable to a non-resident. What are the details? Name, email ID, contact number, address, the tax residency certificate, and tax identification number in your resident country. If you furnish that, 206AA will not be applicable. Are we clear? Next TDS section, very important, is section 195. 195 is applicable on any payments other than the interest which are referred to in 194 LB LC and other than the salaries. Because salaries is tax TDS and TDS on the salaries to the non-resident is covered under 192. So when you make a payment of salary to a non-resident, the payer will not deduct the TDS under 195, the payer will deduct the TDS under 192. So this is applicable on the all other payments other than the interest covered under 194 LBLC and the salaries, right? So even if you make a payment to a non-resident or to a foreign company. So if you remember, I told you, even if a foreign company has a place of effective management in India, still the payer is required to deduct the TDS under 195 and not under 194 CJI, all those sections, right? So here the payer, when he's making the payment to a non-resident or to a foreign company, 195 will be applicable for the purposes of the TDS. Now, in this particular case, the payer can be a resident or a non-resident. So one non-resident making the payment to another non-resident will also be required to deduct the TDS under 195 only. Now you will ask me, how does the one non-resident making payment to another non-resident is required to deduct TDS? So if you see under the interest, royalties, FTS, right? I told you, even if one non-resident makes a payment to another non-resident, the income can still be deemed to accrue or arise in India if the funds are utilized for the purpose of business carried on in India. Even in case of the, if you see the transfer of capital asset situated in India, if one non-resident is transferring the capital asset to another non-resident, still there will be the TDS obligation under 195, right? Because the capital asset is situated in India, therefore the capital gains shall be deemed to accrue or arise in India. Are we clear? So, what is the time of deduction, payment or credit, whichever is earlier? What is the rate of TDS under 195? There is no rate prescribed, so you will go as per the rate under the Income Tax Act or the rate under the tax treaty, whichever is beneficial for the taxpayer. In case the taxpayer feels that the rate is higher, then what is applicable slab is, he can request to the income tax officer to grant a lower deduction certificate. So the payee can request to the income tax officer to grant him the lower or no deduction certificate if he feels that his income is taxable at a rate lesser than the rate prescribed under the Income Tax Act. Further, the payer who is deducting the TDS under 195 has to furnish the information with respect to the payments that he is making to a non-resident under the Form 15CA and Form 15CB, which is the CA certificate. That is mandatory. If they do not, then there is a penalty under Section 271I. Are we clear? Yes, any questions so far? Yes or no? Is this clear? Fine?
Yes, clear.
Okay. So now, one more important point over here. Refund for denying the liability to deduct the tax under 195. So there's a section 239A which says that where there is an agreement in writing that the TDS is under 195, okay, the TDS to be deducted under 195 is to be borne by the payer, right? Is to be borne by the payer. So, usually the payer and the payee can enter into an agreement because the, recipient of the income may say, no, look, I am not going to bear the TDS liability in your country. We don't understand this. Usually the foreign company says like this. So, either you take care of it, you only bear the liability, I will not bear it, right? So if there's an agreement in that regard, and then the payer claims that, sorry, I incorrectly deducted the TDS as per the income tax provision. This income is, let's say, exempt, or let's say under the treaty, this income is not taxable. So then I think that no, there was no tax which was required to be deducted. Now, how do I get my money back? Because this liability was to be borne by the payer, right? So now I have only deducted it. Now I want the money back because there was no liability to deduct. So I can make the application under Form 29D to the assessing officer for the purposes of claiming the money back. Alright? And then the assessing officer can pass the order allowing or rejecting the application. Clear? Similarly, we have a CBDT circular of 2011 which has laid down the procedure for refund of TDS to the person who is deducting the TDS, right? So this circular also allows the refund to the payer in case he has deducted the TDS under 195, and let's say in future the contract gets cancelled and then now we are not required to make any payment to the non-resident, or the remittance is made to the non-resident but the contract gets cancelled and the money will come back to him, fine, or the contract is cancelled after partial execution and therefore now no remittance is to be made, or even if remittance is to be made, it will be refunded by the non-resident, or there is some exemption on the income which is remitted, right, by way of some amendment in the Income Tax Act, let's say the retrospective amendment is made, or some rectification order is passed by the income tax authorities under 154, 264, 248, right? Or I have wrongly deducted the TDS twice, or I have deducted the TDS, made the payment of tax which was not required, or I have deducted at a higher rate under the domestic law, whereas the treaty provides for the lower case, right? So in that case, the excess amount can be claimed back if the tax is borne by the deductor. Are we clear? Right? So in this particular case, what will happen? The non-resident will have to give a declaration that they are not having received any payment, and if they have received, they will not apply for a refund by themselves. Are we clear? So non-resident has to give a declaration in that particular case that the income does not accrue to the non-resident, right? Or arise, or it accrues, but the excess amount in respect of which the refund is claimed is borne by the deductor. And in respect of these cases, no claim of refund will be made by the non-resident. Because it shouldn't happen that the resident is also claiming the TDS back and then later on the non-resident also files the income tax return and claims the TDS back. Are we clear? Any questions, any doubts so far? Yes? Any doubts? Yes? Okay. Fine. So, if the resident deductor wants, he will get the money back with the interest under 244A. Clear? So, in case of refund, if any is basically, being made, the income tax authorities has to then, pay the interest also under 244A. And if there is, let's say, for example, any liability due of that resident, they can adjust the refund against that particular amount also. What we do it under 245. Clear? And Further, in this particular case, it needs to be ensured that the non-resident also doesn't claim the refund back. Further, the circular also permits the refund in respect of transaction with the non-residents which have not materialized or have been cancelled. It needs to be ensured therefore by the AO that they disallow the corresponding amount in the as the expense by the non-resident. So if it shouldn't happen that the non-resident is also claiming the expense. Right? So the expense also will not be allowed because we are giving you the money back because the contract is cancelled now. So now the non-resident also can't say that okay, we'll claim the expense of this sum amount. We'll not allow it. Clear? So this particular circular which is there, this is to remove the genuine hardship which is faced by the payers where they deduct the tax but it is not required. Are we clear about this? Okay. Next is section 196A, which is income from units of mutual fund or specified company. Here the TDS rate is 20%. And again, here basically what they say is that when you make the payment to non-resident, in that particular case, the TDS is to be deducted. Second is income from units. So this is in respect of the offshore fund, which has to deduct the TDS at the rate of 12.5%, right? Which is after 23rd July 2024, plus the applicable surcharge or cess. 196 is TDS if it is income from foreign currency bonds or shares of the Indian company. Again there it is 12.5% on the long-term capital gains, right? And plus the applicable surcharge and cess. So if you remember, yesterday we were dealing with the case of global depository receipts, isn't it? There I told you in respect of the global depository receipts, there is section 115AC which is applicable, right? So the TDS in respect of that long-term capital gain is applicable under this section, which is section 196C. Are we clear? So 196C talks about it. Secondly, in respect of the foreign portfolio investors, in respect of foreign institutional investor, the TDS will be deducted at 20% under 196T. If you remember, we had done the section yesterday under 115AD, their tax rate is there. The TDS will be under 196T. If it is a FII, if it's a specified fund, then it will be 10%. In case they have the treaty benefit, then and if they furnish the tax residency certificate, then the tax rate will be that under the DTAA or 20%, whichever is lower. Fine? Yes or no? Any questions? Any doubt? This is not applicable. TDS is not applicable in the case of the capital gain. There is no TDS in the respect of capital gain. This is only on the dividend income or interest income which will be there. Clear? These are the other provisions which are normally applicable to even the non-resident. 192, as I said, salary is equivalently applicable to a non-resident. 192A, withdrawal from EPF. This is also applicable to a non-resident. Income from winnings, race horses, online gamings, lottery tickets, right? Withdrawal of cash in respect excess of rupees 1 crore. Again, this is also applicable in the case of non-resident. Then distribution of interest income from a SPV to unit holder, distribution of dividend to the unit holder, distribution of the rental income to the unit holders. All these sections are applicable to the non-resident as well. So with this, we have completed the TDS provisions which are there. Any questions, any doubt up till here? Yes. Any doubt, any question? Is this chapter clear to everyone? Clear? Fine. Good. So with this, we are completing this entire chapter on the international taxation, right? Or the non-resident taxation. Now we'll start with the double tax relief. Let me start that chapter. Yeah. Now, students, tell me one thing. When does the double tax happen? Why does the double taxation happen? Any idea? Yes, why does the double taxation happen? Yes, please. Yes,
Ma'am,
Samyata.
globally there are two principles of levy of tax. One is principle of residence, which is applied by the home country, wherein the tax is levied on the entire global income. And the other one is principle of source, where the host country levies the tax on the source income.
Hmm.
So this gives rise to what to say. There are two types of double taxation. One is double taxation, juridical double taxation, and economic double taxation.
Correct. Very good. So, if you look at it, the double taxation happens because if you recollect, let me reshare my screen with respect to the notes that we were discussing yesterday. If you recollect, what we started with yesterday was that a country gets the right to tax when either you are a resident of that country or you have the source of income in that country, right? So let's say, for example, if I'm resident of India, India will be able to tax my global income. At the same time, if I'm deriving this income, let's say from US, right? So US will also be able to tax it if the income accrues or arises in US as per the US tax law. So my same income is getting taxed in India as well as in US. Or let's take an example, if I'm a resident of US will tax my global income. And at the same time, if I am, let's say, deriving the, let's say, royalties from India, because the payer is resident of India, right? So in that case, the royalty income of mine will be deemed to accrue or arise in India as per section 916. So India will also tax that royalty income. US will also tax that royalty income, right? Because I'm the resident of US. So on the same income, I'm paying, let's say, 20% tax in US and let's say 20% tax in India. So 40% of my tax goes in, 40% of my income goes in the taxation. So will I have any incentive to, do the cross-border transaction? I'll say, no, I don't want to, engage in any cross-border activity because this is like not giving me any benefit. Instead, I'm good in earning in one
Heavy
country.
tax burden.
Correct?
Yes.
Yeah. So that will impact, the overall objective of the governments worldwide to enhance the, geopolitical, to enhance the global trade, right? So if the businessman is not having any incentive to basically move the income or to basically trade with the other countries, how will the nation survive? Because every nation is not, completely independent. They are dependent. Like, for example, we are importing oil, we are exporting the agricultural products, we are exporters of cotton. So there are some nations where the agricultural activities are not there. Look at the island nations. So, this is the entire scheme that you need to understand, that why there are certain countries which have the lower tax rate, why there are certain countries which have the higher tax rate. That's all because, you know, if you talk about the country like India, India is a very high tax jurisdiction. What is the reason for that? Because the reason is that we have the good amount of human population. We are the second largest country with the population, right? So, in respect of that, we say that, okay, we have human resources. So, therefore, this can be a country which is the labor intensive country. The other countries are able to come here and set up their operations in India to utilize the cheap availability of labor. And that's how you see in these days, there are a lot of BPOs, there are a lot of KPOs getting opened up in India. There are a lot of back office operation, manufacturing setup being opened in India. What is the reason? Labor. Cheap labor, cheap land, isn't it? So India says that, okay, I have good amount of labor. I can do the export of services, right? This is nothing but the export of service. We are rendering the services to the other countries. So India is able to tax at a higher rate even the non-residents or the residents. Because we have like a good amount of resources, we have good agricultural operations. This is something that we can earn the tax, like government's revenues from the tax itself, right? So the government can earn from the activities that are happening. Now let's take the example of the island nation. Let's say Cayman Island, let's say Mauritius, let's say Maldives. Where is the land? How will they do agricultural activity? Where is the labor? Because there is no land, there is no labor. All that they can earn from is the tourism. But will tourism bring the returns equivalent to the tax amount? The answer is no. So that's why those countries have started demonstrating themselves as the tax havens. What these countries tried to do, they said, you come, incorporate your companies over here in our country. We will have the banks which will not share your information globally to any other country. So we'll keep the banking secrecy. Nobody will know that you have your black money stashed in our banks. Switzerland, it's such a small country. It knew it can't, flourish because it didn't have enough land. It's a mountainous region, right? It didn't have agricultural operation because again, it's a snow-clad all mountains. How would they do agricultural activity? So the only way they could earn or survive was to operate as the low tax jurisdiction. By that result, most of the companies started moving their basically incorporation, not the operations. The companies can't move the operations, right? There is no labor, there is no land, there is nothing. They can't manufacture there. So at least they started opening up the companies over there, and most of the people
Is it
also
by
started
opening
showing
shell
their residency also
companies?
there. What
Sorry.
they do is they tell you that, okay, you come in our country, pay certain investment, make certain investment, and we'll give you the passport. We'll give you the citizenship. We'll give you the residency of our country. UAE is again the classic example. UAE is a barren land. It's a deserted area, isn't it? So again, the only way it could grow was not through the manufacturing agricultural operations. It could grow because it didn't have tax. Right? Now, if it doesn't have tax, people will go and move their residency to UAE. There is something called as golden visa program. Right? So wherein if you pay certain investment to the country, they will give you the passports, they will give you the residency. You can easily open up the company within a day in all these jurisdictions, and you'll be called as a resident of that country. Right? So that is how these countries were flourishing. But if you talk about the country like UK, US, England, right, Germany, France, these are all the developed country. These were the exporter of the services. These were the exporter of the goods. They were very good with technology. So again, these are high tax jurisdiction, right? So if the country, in one country you have the residency, in other country you have the source of income, both countries will tax it unless the country chooses not to tax you. That is the result of the that basically results in the double taxation. Are we clear about this?
Ma'am, instead of shifting the entire base of one's business to these low tax jurisdictions, the shell companies are created. Is that the way through which, it is worked out generally to, uh, as per the discussion that we had now, to achieve the objective of reducing the tax liability? This is the way out companies may resort to, right?
Absolutely. And that's the reason why, we had this place of effective management concept, because prior to 2016, under the Income Tax Act, the condition was that uh, if you are an Indian company which is incorporated in India, or if you have the management and control wholly in India. That was the definition under the Income Tax Act for the residency of the company. Now, companies were very smart enough. They would say, we'll conduct one board meeting outside India and we'll become non-resident in India, because the management is not wholly in India. Unlike the partnership firms, HUFs, AOP, where they say control and management wholly or partly in India, for companies, this was not the case. And that's where the Indian government realized that, look, this is resulting in the tax avoidance. The companies are in fact getting incorporated in Swiss, in Mauritius, in Singapore, and they are basically doing everything from India, and they would just hold one board meeting outside India and say that no, there is no residency of this company in India. That's where they introduced this concept of the place of effective management. Right? Okay. So if you see, this is a very, very interesting topic. Like, for example, at this moment, if you see that the way this entire landscape of international tax is shaping up, it is dependent on several factors, right? What you study as a part, like tax is not just law. Of course, there is a law behind it where you try to interpret that whether where this comma is written, is written, the is written, what does that mean? But there is something much beyond that. When this particular provision is introduced, there is the objective with which that provision gets introduced under the income tax law. So the countries think about that, the businesses, whether they are like shifting the operations, or they want to attract the businesses to move the operations in the particular country. If they are shifting the operations from a particular country, they would introduce the tax avoidance provision. So what you see, the guard, what you see, the specific anti avoidance rule, like 56 to 10, 222E, 72A, 79, right? All these provisions were not something existing since 1961 in our act. These generated because when India was in the huge need of funds, when India was into running into like almost bankruptcy at one point in time, India was in the need of having the foreign direct investment. And the Income Tax Act was very, very liberal. But once we became stable, once we started seeing that, our biggest asset is our labor, India realized that, the countries are in fact now, or those companies are in fact now getting into the tax avoidance. And then they started introducing all these provisions. So 56 to 10, 222E, these are very new provisions. They have come in last, 10, 15 years. It's not something which is existing since many years. So that's how the act evolved. And on the other hand, there are countries which are, to invite the foreign direct investment, are liberalizing their tax act, right? In a way to see that, okay, there is no tax on capital gain in Singapore. So you will see that more and more companies will now start investing in Singapore, in Mauritius. They have favorable tax treaties. So the entire taxation which is developed, the tax policies which are developed, are result of the geopolitical factors. How the other countries are responding. So today, as we stand, that there are so many things that are getting discussed amongst the country. Whether this will get implemented or not is not about the country's own choices. It's also dependent on how the other countries are reacting. Like, I don't know if you have read about the recent reports regarding how US is retaliating with the countries which are implementing the global minimum taxes. So global minimum taxes was a product of the discussions that happened at the OECD level, wherein the countries realized that there is a lot of tax avoidance which is taking place because of these low tax jurisdictions. The companies are incorporating in these low tax jurisdictions without actually having the operations there, because of which the investment is moving away from one country to another country without moving the actual operations to that country. And this is resulting in the tax avoidance, the pressure on the domestic resources, right? So it was thought that we should have something like the minimum alternate tax that we have in our country. Something like that should be present globally. And most of the countries agreed for that. However, US felt that if it agrees to this, US is the country which is the biggest exporter of the goods, services, technology, everything. Right? It's a capitalist country. So US companies will be paying their taxes in all the other countries. And in fact, US will get, very less tax, because what will happen if there is a double taxation which is happening, because all the countries are taxing now US companies. US can't say that, okay, I will not give you the credit of taxes paid in other countries. Because otherwise, how the US companies will earn? If US tomorrow says that, look, I will not give you the credit of the taxes that you pay in other country, let the double taxation happen, there will never be any foreign exchange coming in US. US can't afford that, right? So US will say, I will have to give credit. But if the US gives the credit, it will earn the foreign exchange, but it will lose out on the tax revenue that it was generating till now. So US has started putting the tariff. US has in fact introduced something called as, a big beautiful bill, where they are putting the tax. If any country is going ahead with the global minimum taxes, we will impose the higher withholding tax, something like 206AA, double the existing TDS. So this is how then the US is trying to restrict or create a pressure on the other countries that if you continue with the global minimum taxes, we will put the higher withholding taxes whenever there is any payment being made from our country to your country. Right? So obviously the other countries will worry. And they may not be, willing to go ahead, even though they want to go ahead with this, but there is a pressure from US. Isn't it? So that's how the entire geopolitical situation is influencing the international tax landscape. And that makes it a very, very interesting area to look forward to study this in detail. Are we clear? So let us go back to our then discussion that we were doing with respect to the double taxation. As I was talking about, that this double taxation is occurring because of these two source and the residence conflict, right? That's the reason for having the double taxation. So coming back to this, now how does the country gives the relief of the double taxation? There is something called as bilateral, there's something called as unilateral relief. Bilateral relief means what? I agree with US or I agree with any other country that under the tax treaty, if both the countries have the taxing right, or there is the tax which is paid in the other country, I agree that I will give the relief as a resident country. I will get the relief. I will give the relief to my resident of the taxes paid in the other source country. Right? So the source country may get the right to tax under the tax treaty. But if there is a taxing right, then I as a resident country promise under the tax treaty, I will give my resident the relief of the taxes paid in the other country, so that there is no double taxation. So my resident, if he is, earning income domestically, or if he is earning the income in a foreign country, he will be indifferent because the tax liability will remain the same. This concept is called as the concept of capital export neutrality. So that, what does it mean? That so that when you make the investment in the other country, it should be tax neutral. Whether you pay domestically or do business domestically or whether you do business internationally. Are we clear? Now, if I do not have the treaty with the other country, if I do not have treaty with the other country, but there is tax paid in the other country, then India says that no problem, we will give unilaterally the relief to you. Even if you do not have the treaty with the other country, if you have paid the tax in the other country, we will give the unilateral relief. So this is the meaning of the bilateral and the unilateral relief. Now, how does the relief is given? So there are two methods. One is the exemption method, second is the credit method. What is the exemption method? Exemption method says that if the income gets taxed in the source country, the residence country will exempt this income in entirety. So we will not include it in the total income itself. Let's say capital gain tax is another country. This country will, or I as a resident country will not include it in my total income. I will consider it as exempt. That's one way. Many countries follow that. Second is the credit method. Just like my TDS credit, I will give the credit of the taxes in other country. So India follows the credit method. India doesn't follow the exemption method. We don't give the exemption. We don't have any exemption of the foreign income. We say that we will give you the credit of the taxes that you pay in the other country. So we'll include the income in the total income and then we'll give you the credit of the taxes that you pay in the other country. Are we clear? Any questions so far? Yes? Fine? Okay. So, section 90 and 91 talks about the relief which is given. Now, first we come to section 90. Section 90 says that, or rather empowers the central government to enter into treaty with the foreign country. Now, you have to understand this a little bit, you should know the background about it. So, how does the governments enter into tax treaty? Any idea? Who has the power? See, when you talk about the Income Tax Act, who has the power to legislate the Income Tax Act? Like if you see there is a new income tax bill which has already been put in place. So who has the power to legislate the Income Tax Act? Yes. Parliament. Yes, Samnathan. Correct. So Parliament has the power to legislate on any act, right? On any, not just Income Tax Act, but any act. Now, as far as the Lok Sabha is basically where the money bill gets introduced, right? If it's a money bill, it gets introduced in Lok Sabha. Once Lok Sabha passes, then it goes to the Rajya Sabha. So Lok
Yes, ma'am.
Sabha is nothing but the part of the parliament only, right?
Actually, only any money bill can be passed through only the Lok Sabha, not by the Rajya Sabha.
Yes, it will get introduced in Lok Sabha. Once Lok Sabha approves, then it goes to the Rajya Sabha because Lok Sabha is nothing but the house of the people.
Yes.
Right? So the procedure for the money bill is that it will go to the Lok Sabha, Rajya Sabha, presidential assent, right? And then it becomes the act. Now, as far as the treaty is concerned, see, any legislation, whether it is income tax, whether it is any other act, where is the authority to legislate any act? Who authorizes, like, who says that the parliament has the authority?
Constitution, ma'am.
Correct. Constitution of India. So that is basically the main authority which is regulating or deciding who has the power to do what in the country. Right? So Constitution of India basically also gives the power with respect to the treaty and entering into the tax treaty also. Are we getting this particular point? Now, what does the Constitution of India says for the tax treaty? So, the Constitution of India basically gives the power to the Parliament to enter into the tax treaty. So, the Parliament has the power with respect to entering into the tax treaty. It is not that, that if you look at the tax treaty, whether have you seen that Parliament passes the tax treaty? See, you have looked at, the union budget. You have heard many sessions of the Parliament. Have you ever seen that Parliament, therefore, passing the tax treaty? Yes. Have you ever seen? Yes. Does the Parliament passes the tax treaty? Yes or no? No.
No, madam, only the central government gets the power.
Correct. But Article 253 of the Constitution says that the treaty will be the passed by the Parliament. Right? So, how does then the treaty never gets passed in the Parliament? That's a point to wonder, right? Isn't it? So, there is something called as delegated legislation. Are we getting it? So, our Constitution has delegated this, or Constitution has asked the Parliament to enter into tax treaties. Isn't it? So, Article 253 of our Indian Constitution says that the power is with the Parliament to make any law for the implementing any treaty. So the Parliament, by way of the Income Tax Act, the Parliament by way of the Income Tax Act, so who has legislated the Income Tax Act? The Parliament itself, isn't it? So the Parliament, by way of the Income Tax Act, has delegated this power to the central government. Are we getting this particular point? So this is a delegated power which is given via Income Tax Act to the central government to enter into the tax treaties. So it is not that the Parliament is, going to pass each and every tax treaty now. No. As per section 90, if you look at it, the 90 authorizes the central government to directly enter into tax treaty. Because if you look at Article 246 also of the Constitution, the Parliament has the power to legislate on the matters which are in list 1 of the Schedule 8 to the Constitution. And in list 1, there is an entry 14 which says that one can enter into tax treaty with the foreign countries. But as per section 91, the Parliament has delegated this legislation. Are we clear? Yes or no? So, this is how the treaties are entered into. Clear? Any questions? You see, section 90 is a very, very important section. Fine. Now, section 90 says that the objective of the entering into tax treaty is to grant the relief of the taxes in respect of the taxes paid in both countries, to avoid the double taxation, and also to prevent double non-taxation if it is happening through treaty shopping arrangements. What is the meaning of treaty shopping? What is the meaning of treaty shopping? Yes, nobody? See, treaty shopping means that, how do you go to a mall, and when you want, let's say, some shoe, what do? You ask the price in different stores, and then only you will buy. Or if you want, let's say, a television, what you would do, you will go to mall, you would inquire in
Inquire
the
at
LG
various
store.
places.
Correct? You will go to the LG store, you will go to Chroma, you will go to Vijay Sales, you will go to Reliance, and wherever you find the cheap price, you would buy it from there, isn't it? Same happens with the companies. What they do is they look out for the countries where the tax rates are significantly low or zero, where the incomes, or even if the tax rates are not low, certain incomes are not taxable, and the countries with which the ultimate source country has the favorable tax treaty. Let's say if I want to make the investment in India, I want to do the business in India, I'll not directly come to India. If I directly come to India, I'll pay tax in India, I'll pay tax in my home country. Of course, I'll give the credit. But if I do it through, let's say, some tax haven country, Switzerland, Mauritius, Singapore, I will not be paying tax in those countries. Plus, there is a favorable treaty between Mauritius, India, Singapore, India, as compared to my country and India, which is, let's say, US and India. So I will do the treaty shopping. That is the meaning of treaty shopping. So if I am doing the tax avoidance through treaty shopping arrangements, the treaty is not going to permit it. The treaty will be denied in that case. So the objective of section 90 is now not just to prevent double taxation, but also to prevent double non-taxation. Are we
So,
clear?
ma'am, treaty shopping, actually, it is done simultaneously. Is it? I mean, I didn't get it. I mean, to avoid misuse, abuse of it, and it is done all together. I mean, to take advantage of it, to take benefits of the reduced tax rates. It works in that way. Am I getting it right?
Yes, it works in that way. So basically what you do is let's say for example, if I invest, I'm a US resident, if I invest in India, I actually want to do business in India, right? Now, if I do the business in India and I'm a resident of US, I know India will tax me. Let's say there's a treaty between India and US as per which India will tax my, let's say, royalties or FTS income at the rate of 20%. Let's say under treaty also, right? And US will give me the credit of that taxes. But now, if I interpose a sham entity, a special purpose vehicle, or an intermediate entity in Mauritius. So I am a US company. I will invest in a Mauritius company, and then that Mauritius company will make an investment in India. So what will happen in that case? Let's say there is a treaty between India and Mauritius, which is taxing only at the rate of 5% interest, royalty, dividend. So obviously, I will get the benefit of 5%. Plus, Mauritius is also not going to tax that income. Double benefit. So by that way, I am doing the treaty shopping. Clear?
Fine, double the benefit. Okay.
Yeah. Fine. So basically, treaty shopping is done to get the double non-taxation or reduced taxation as what I would have got if I would have directly invested. So there's no purpose of investing in Mauritius other than just to gain the benefit of the tax treaty in Mauritius. That's a different story. Let's say, for example, if there I'm having the real operations in Mauritius, that's fine. That's not treaty shopping. Because I've come to Mauritius for some commercial reason also. Let's say Mauritius is a good financial center, then it's fine. But we know that it is not. So in that particular case, it will be considered as treaty shopping. Are we clear, students? Then the
Yes,
purpose
ma'am.
of treaty is also to exchange the information. So the purpose of treaty is not only to avoid the double tax, avoid double non-tax, but it's also to exchange information. See, the countries, when they enter into treaty, they say that, look, we are, entering into the treaty with you, right? So we know that we are going to get the foreign direct investment from each other. And that is the reason why we are saying that, okay, let's make an agreement. Both of us will reduce the tax that we would have charged to each other's resident. You agree that, okay, you will charge, let's say in your domestic law, you charge 20%, but you agree under the treaty that you will only collect 5%. I agree that I will give my resident the credit of 5% that they have paid in your country. So both of us are, losing something and gaining the foreign direct investment in return. So treaty is nothing but the bargain. But look, both will say to each other, it shouldn't happen that, you are in fact promoting my residents to take the black money or the black money that is generated in my country, you are, or in anywhere in the world, you are allowing them to store in your bank accounts. That shouldn't happen. You promise me that. So both the countries promise each other that they will share the information with respect to each other's residents about whatever bank accounts they have, about whatever assets that they have in that country, so that there is no tax avoidance happening in the other country. Are we clear? Plus, they also promise that in case we are unable to collect the taxes, your resident is not paying taxes in my country. Now, how do I catch hold of him? He's a non-resident. He's not going to come to my country. So I will request the other country which I have treaty, that you will help me in recovering that income tax. So that is also the objective of the tax treaty. Are we clear? Yes or no? Then if you look at section 90, it says that wherever there is a tax treaty, section 90 says that if there is a tax treaty, the provisions, if under the treaty are more beneficial, that will apply. If the provisions under the act are more beneficial to the assessee, that will apply. However, if the assessee is engaging in tax avoidance, then in that case, if the GAR becomes applicable, now even if the treaty may be beneficial, but if the assessee is engaging in any kind of tax avoidance, the GAR will override the tax treaty. Are we clear? Yes or no? Any doubt, any question? Fine. Next is the section 90 provides that the charge of tax in respect of a foreign company at a rate higher than at which domestic company is chargeable shall not be regarded as less favorably charged or levy of tax in respect of such company. What does this mean? So under the tax treaty, there is one clause called as non-discrimination clause. What is it called? Non-discrimination. Again, this is a promise by the two countries to each other where they say, look, you promise that you will not discriminate my residents vis-a-vis your own residence in respect of any tax provision under your domestic law. So it shouldn't happen that, just because a person is a non-resident in your country, you will discriminate him by charging him higher tax or by not giving him any benefit that you are allowing to your own resident. Are we getting this particular point? So, the Income Tax Act, if you look at it, what is the tax rate for a foreign company? Yes.
35%.
Correct, 35%. And what is the tax rate for a domestic company?
50.
How much?
22.
How much it is? Sorry?
15%, 22%, 25.
Correct. Now, isn't it a discrimination between the two? Foreign company is taxed at 35. Indian company at only 22, 25, maximum 30. Isn't it discrimination? Yes or no? Yes?
Yes, ma'am. As per this, it is, but law says no.
Correct. So, if you look at it, it says that Section 90 says that this may be discriminatory. But law says, Section 90 says that even if we are charging a higher rate to a foreign company as compared to the domestic company, this will not be regarded as discriminatory. This will not be regarded as discriminatory. Are we clear? Any questions? Any doubt? Fine? Yes or no? Then, if you see, it says that any term which is not defined in DTA and not defined in the Income Tax Act also, then the central government has been given a power to define that term by way of a notification. So if a term is not defined in treaty, you can look for the meaning of that term under the Income Tax Act. If the term is also not defined under Income Tax Act, then the central government has been given power to define that term. So the central government has notified that whenever the treaty provides that the income may be taxed in other country, it doesn't mean that India does not have any taxing right. India will include that income in the total income and then will give the credit of the taxes paid in other country. Are we clear? Lastly, Section 90 provides that in case a person wants to claim the benefit of tax treaty, any person who's a non-resident in India wants to claim the benefit of tax treaty, he can do that only when he furnishes the tax residency certificate and Form 10F. What is a tax residency certificate? Tax residency certificate means that you are given a certificate by the country, by the other country of which you are resident, of which you are claiming the treaty benefit. Let's say India US benefit you want to claim. So you will get the tax residency certificate which is issued by the US tax authorities duly certifying that you are a resident of US. So it's a certificate given by the tax authorities stating that you are a resident of so and so country. And Form 10F is nothing but it just gives the information with regard to that assessee. What is his status? What is his nationality? What is his tax identification number? The period for which he is resident and his address. That's it. Are we clear? So anyone who wants to claim the treaty benefit, it can claim only when it has the tax treaty, tax residency certificate. Clear? Now, where there is no tax treaty, then India has agreed that we will give you the unilateral relief. We will give you the unilateral credit of the taxes paid in other country. But what are the conditions? It is provided in section 91 that the assessee is a resident in India, that he has earned some income which is accruing or arising outside India. The income is not accruing or arising in India. And the income tax is subjected to tax. So the income is subjected to tax in the foreign country. And the assessee has also paid the tax in the foreign country. And India does not have any treaty with that country. So India will give the credit of the tax on that doubly taxed income at the rate applicable in that foreign country or the income tax rate whichever is lower. Are we clear? Yes or no? Any questions? Any doubt? Is this clear? Fine. As far as if you have the tax treaty, whenever there's a tax treaty, how will India give the credit? For that purposes, India has come up with the foreign tax credit rules. So foreign tax credit rules, rule 128 provides that again, India will give the credit of the taxes paid in the foreign country to the extent of rate under that country or the rate under the income tax, whichever is lower. And now you will have paid tax in the other country in foreign currency. So how will you convert it into INR to claim the credit? You will use the telegraphic transfer buying rate, TTBR, as on the last day of the month, immediately preceding the month in which the tax is deducted or paid in the other country. Clear? Is this clear, students? Point? Yes or no?
Yes, ma'am.
Fine. So shall we solve one question on this particular point? Yes?
Yes, ma'am.
Fine? Okay. So let us solve a question from your module itself. Let me open up that question. Yeah. Mr. Kamesh, an individual resident aged 52 years, furnishes you the following particulars of income earned in India, country X and country Y for 24-25 previous year. India has not entered into DTA with these two countries, meaning section 91 will be applicable. Income from profession carried on in India, 7,50,000. What will be its taxability? Yes. Yes. Faster. Income from profession carried on in India.
It's income from business and profession, ma'am, in India.
So this will be taxable, right?
Yes, ma'am.
Fine. So this will be taxable in India. That's correct. Agricultural income in country X, gross 50,000.
Taxable in India.
This will be taxable
It
in
will be
India.
taxable.
Correct. This will be taxable under which head?
It can be, if it's profession, then business and profession. Otherwise, income from other sources.
Income
Correct.
from other sources.
See, this will be, we will tax in income from other sources, right? Agricultural income in country X is not, like looking like my profession, so we'll put it under income from other sources. Are we clear? Next one, dividend from a company incorporated in country Y, gross 1,50,000.
Income from other sources.
Income from other sources taxable.
Income from other sources taxable. Okay. Royalty income from a literary book from country X, 6 lakh.
If it is business, then income from business, and otherwise income from other sources.
It is taxable plus you are eligible for deduction under 80 QQB, which is actual or 3 lakhs, whichever is lower.
Very good.
But when, ma'am, 115 BAC followed, then we will not take this.
Yeah, if you're
80,
following 115 BAC, then you will not tax it. That is correct. So 80 QQB will not be available in that particular case. So that is correct. So that you have to, take an assumption that what is the tax rate that you are following. Whether you are going as per the normal
Assumption has
act.
to be taken, right?
Correct. Yes.
Okay.
So,
And your net off will be taken, is it? Matlab, your expenses are also given.
correct. Here you will get the expenses also and this also. But if you look at the question, it says compute the total income, assuming that he has opted out of 115 BAC. So here, this is
Okay.
6 lakh, right? Minus, we will do the expenses incurred for earning the royalty. Isn't it? Is this what stopped? I think it just got hanged.
Yes, it has got stuck.
Yeah. 1 second. Then I'm not able to see my own screen. Yeah. So here you will get the royalty 6 lakh minus you will get the expenses which is 50,000, right? And plus you will get the 80 QQP because you are given here that you have opted out of default Zaji.
Opted out of.
Correct? So you will get the 80 QQB. Next is business loss in country Y from a proprietary business 65,000. So business loss in country Y is not eligible for set off against other income as per the law of that country. This is what they are given in the note.
But ma'am, we are making it for as per income tax law, so
Correct.
we want to deduct it.
Correct. So we will allow it because we are following the income tax provision. So we will allow. Even if in other country that's not allowed, that's their problem. Rent from a house situated in country Y, 2,40,000. Municipal tax paid in respect of above house, not allowed as deduction in country Y, 10,000.
Standard deduction, this 30% will apply because
What
this is
about
in
municipal
country Y.
taxes?
Municipal taxes, it should be allowed.
Correct.
So
So you will get the
230,
municipal
30%.
taxes also. Yeah. Right? So if you see, this is how the computation will look like. GAV you will take, right? So you will assume that the GAV is taken rental income has been taken as GAV in the absence of fair value or the municipal value, right? Less 10,000 municipal taxes and deduction of 30% standard deduction, you will get 1,61,000. Under PGBP, I have taken 750 as the income from profession. I have taken the royalty 6 lakh minus 50,000 expense, and I have allowed the
Then
business
set
loss.
off.
Correct. Okay. Now, and under the IFOS, I have agricultural income and the dividend. Fine. And I have the 80 QQB deduction, which is for the income of a resident from the literary work. But you have to make an assumption over here. What is the assumption that you will make in respect of the royalty income, which is from the foreign exchange? You have to assume that it has been brought back to India within 6 months. So royalty earned outside India has been brought to India in convertible foreign exchange within the period of 6 months from the end of previous year. This assumption has to be made, otherwise 80 QQB will not be available. Clear? So 3 lakh, and this will give you total income of 12,96,000. Plus you will write that here AMT is not applicable because you are not even claiming any specified deductions, right? So even if it would have exceeded 20 lakhs, correct. If it is exceeding 20 lakhs, still AMT will not be attracted. Are we clear?
Yes.
Now, I will calculate the tax on this as per the normal tax regime, right? So this will be my tax, which is there. No surcharge because this is not exceeding 50 lakhs. Only the education cess. Fine. This will give me my tax liability. Now, how will I calculate the relief under section 91? So relief under 91 will be applicable because this is a person who is a resident in India. The income accrues or arises outside India and is not deemed to accrue or arise in India. The income has been subjected to tax in the foreign country and he has paid the tax in that country. And India does not have any DTAA with country X and country Y. Right? So how will we calculate the relief? Let us understand that. So first of all, I will find out what is the average tax in India. Average rate of tax in India. So what will I do? This 2,09,352, which is the tax liability coming before the relief, divided by my total income of 12,96,000 into 100 will give me the average rate of tax in India, which is 16.154%. Now this I will compare it with the tax rate in country X and country Y because the lower of the two I will get as the credit in India. Are we clear up till now?
Yes.
What is the average rate of tax in country X? It is given in question 10%. So what is lower out of the two? 10. Right? So now on this income which has been taxed in the foreign country, right? The income which is taxed in the foreign country, on that I will give the relief on the doubly taxed income. So for country X, what is the income which is taxed there? How much is the income? This is income in country Y. So this we will not include. Royalty income from a literary book from country X.
Royalty income is there.
Correct. So what will you consider? 6 lakh, 5 lakh 50 or 5 lakh 50 minus 3 lakh? What is the amount that you will consider? 6 lakh, 5 lakh 50 or 5 lakh 50 minus 3 lakh, that is only 2 lakh 50. 6 lakh, 5 lakh 50, 2 lakh 50. What is the amount that you will consider?
2 lakh 50 minus.
Why?
Because in India, 3 lakh rupees is given deduction. There it is given or not, we don't know, ma'am.
No, it's not like that. See, you are right in your answer, but the reason is that what is the doubly taxed income? What is the income which is getting taxed in India also and in the country X also? Is it 6 lakh? No. Country X has taxed 6 lakh. Right? Or country X is tax 6 lakh minus 50, 5 lakh 50. Right? But from the Indian standpoint, is India taxing 5 lakh 50 or is India taxing only 2 lakh 50?
250, ma'am. 2 lakh 50.
Right? Because we are giving a deduction of 3 lakh. Correct? So the doubly taxed income, the income which is getting taxed in both the country is not 5 lakh 50. It is just 2 lakh 50. Because only on 2 lakh 50 you are paying taxes in India also and in country X also. India was not taxing entire 5 lakh 50. So the doubly taxed income is only 2 lakh 50. So as per the ruling in R.N. Jhanji, Rajasthan High Court has held that the amount which is claimed as deduction under Chapter 6A is not doubly taxed. And no relief will be allowed in respect of that. Are you getting this particular point, students? Yes or no?
Yes, ma'am.
Fine. So the doubly taxed income will be here only restricted to 2 lakh 50. So on this 2 lakh 50, what will be then my tax credit? Yes, 10%. Right?
Lower of the two, 10% will apply.
So 50,000 agricultural income and 2 lakh 50 royalty income. So on 3 lakh, 10% being lower, 30,000 will be my foreign tax credit under 91 with respect to country X. You will calculate country wise, not the aggregate credit, because the tax rate is different in country X and country Y. Similarly, for country Y, the average rate of tax is 20%. But what is the average rate of tax in India? 16%.
Yes.
Right? So 16% is lower. Fine. Now, what is the doubly taxed income in India as far as country Y is concerned? We have house property. So whether you will consider 2,40,000 or you will consider 2,30,000 or you will consider 1,61,000.
It's 161, ma'am.
161 is the doubly taxed income because India is giving the standard deduction, right? So we'll consider 1,61,000. Then you had the dividend, which is 150 only. Fine. So 150, 161 comes to 3,11,000 plus you will also get the set off of the business loss in country Y because we are allowing you that set off. We are not taxing on that amount since we are giving you the set off of the business loss in country Y, even though country Y has not given you the set off. In India, I am allowing you that set off. So therefore, I am collecting less tax from you. Yes or no? So I will reduce that amount and my doubly taxed income will be 2,46,000. Are you getting this point? Yes or no?
Yes.
Yes, ma'am.
So deduction under 91 will be 2,46,000 into 16.14% will give me 39,739. So my total foreign tax credit will be 30,000 plus 39,739, which comes to 69,739. I will reduce this from my Indian tax liability and my net tax liability will be this amount. And then you will round it off to 610. Is this question clear, students? Yes or no?
Yes, ma'am.
Yes.
Fine. So last topic in this particular chapter is regarding the permanent establishment. Now, what is the meaning of permanent establishment? Till now, I have been telling you permanent establishment means a branch or an office in India, isn't it? So permanent establishment is the, synonymous, or we can say a similar term to the term business connection that we have studied yesterday. What did I tell you the meaning of business connection?
When business activities are done in India, then Business connection will arise.
Correct. So when there is a connection between the business activities and the income which is earned from that. Isn't it? So business connection is basically used under the Income Tax Act to signify that whether the business income of the non-resident will be taxable in India or not. Right? That is kind of a nexus. It is a connect by which India gets the taxing right under the Income Tax Act. But business connection is not defined. Is it defined under Income Tax Act? No. That's what I told you is the meaning which has been derived by the judicial precedents. So it is not defined. Under the tax treaty, in order to tax the business income, the word business connection is not used. The word used is permanent establishment. The meaning is as simple as that. Permanent meaning for a longer time, fixed in nature, right? Something denoting permanence, continuity, right? Establishment means some kind of presence, office, some establishment. As simple as what the term is saying. But the business connection, since it's not a defined term, it's a very wide, like you can, say anything can be business connection because this is not defined. But the term permanent establishment is very well defined under the tax treaty. The treaty very clearly says that in which cases the permanent establishment will be there. The treaty generally says that generally permanent establishment means a fixed place of business through which the business of the non-resident is being carried out. Through which the non-resident is carrying out the business. Right? Fixed place from where the non-resident is carrying out the business. Just like, some office, some cabin, some kind of, stall, something like that. It's a fixed place. This term is also used in transfer pricing, section 92F. 92F is for TP. It is not used in section 9 for the purpose of accrual, deemed accrual. It is not used for that. It is used in the transfer pricing. There the term PE is used to say that if there is a transaction between the PE and the head office, that will be subject to the arm's length principle under section 92. So the term PE is also defined in 92F for the purposes of transfer pricing to mean a fixed place of business. There also is a similar definition through which the non-resident is carrying out the business. But the treaty also says that the PE includes a place of management, a branch, an office, factory, sales outlet, workshop, warehouse, a mine, oil or gas well, any other place of extraction of natural resources. These are examples of PE which are given. Are you getting this? Again, I think my screen is stuck. Are you getting this particular point? So if the non-resident has a branch, office, factory, any kind of, establishment which is a fixed, through which the non-resident is carrying out the business, means that there will be a permanent establishment in the source country. And if there is a permanent establishment, the non-resident's business income will be taxable in the source country. Are we clear? You have seen yesterday under section 44DA, if there is FTS, for the taxability of FTS, what did I say? What will be the tax rates for the FTS? I told you yesterday only. Let me reshare again. Yes. If
NT
non-resident has a PE in India, the FTS will be taxable on the net basis under 44DA. Meaning you will get the receipts minus the expenses, you will tax at 35%. Expenses which are wholly and exclusively for the PE. If the non-resident has no PE in India, FTS will be taxed at 20% on gross basis under 115A. Do you recollect this? Yes? So it's
Yes.
the same thing over here. Now, one question which is usually, tested in examination is whether liaison office can be said to be constituting the permanent establishment in India. What's the liaison office? As the name suggests, it's a licensing office. It is licensing between the customers in India or just collecting the information in India with respect to how the market is, how basically, the customer's demand is. It's just a liaison office. Licensing. It is not earning any profits. It is just information collection center or some kind of, support center for the foreign company. So as per the FEMA regulations, one has to take permission of the RBI before opening a liaison office. They have to give a declaration that this is only the purpose of this office, only to liaison. They are not
It
doing the
acts as an
activity.
intermediary between the head
Correct.
office or the
Correct.
branch which is working in
Correct.
India. So,
Correct.
okay.
So they are doing just, some support function, print out, marketing, not marketing also like, collecting information, doing some research for the foreign company with respect to the market like that. Basically, they are doing some preparatory work or auxiliary or, support function. So it has been held in several cases that where they are just acting as a communication channel, they were not doing any core activities. They are not the permanent establishment. Because under the permanent establishment, there is a specific exclusion. Preparatory auxiliary activities will not constitute the permanent establishment. Only where you are doing the core activities, you are identifying customers, marketing, doing the price negotiation, discussing the commercial of the product, securing the orders, then it can constitute the P. But only if it is, doing some preparatory work, auxiliary work, it will not constitute P. Clear? Any
Yes.
questions, any doubt? Fine. So with this, we complete this particular topic as well. And we'll take a break over here and then we will start with the amendments which are applicable for your attempt. Fine? So let's take a break
Fine,
of
ma'am.
10-15 minutes over here.
Yes.
Yeah. going to look at the amendments. So first, we will once. There's some problem. Yeah. Okay. The screen sharing also, I think, stopped. Okay, let's see what are the first statutory updates which are applicable to you. Okay, I hope you are able to see my screen. Yes?
No,
Is the
ma'am.
screen visible?
Not yet. Not yet, ma'am.
Just give me a for this particular attempt. So let me just open up the again. Okay. So first is for the TDS and TCS. Let's see what are the amendments. So first there's a notification which has been issued in March, which is regarding non-applicability of TDS provision in respect of certain payments made to the specified units located in IFSC. So Section 80LA, if you know, it provides the deduction for the income from the IFSC, right? And Section 197A allows the government to issue the notification to provide that the TDS may not be applicable on certain transaction. So as per the power given to the central government under 197A, read with Section 80LA, the CG has issued the notification that the TDS is not required to be deducted in respect of the specified payments made by any payer to a payee being a unit of a IFSC. What are the payments which are there? So for a banking unit, if the recipient is a banking unit, any interest income on the external commercial borrowings or loan. So if you see, whenever the interest is paid on the ECBs, 195, because this is not covered under 194 LC or LD, right? So TDS will be applicable on 195. But it says if the recipient is the IFSC unit, there is no requirement to deduct the TDS. What is ECB? ECB is the borrowings in the foreign currency. External commercial borrowings in the foreign currency. That is called as the ECB under FEMA. So no TDS is required to be deducted. Any professional fees under 194J, referral fees under 194H, brokerage income under 194H, commission on factoring and forfeiting services under 194H, there is no TDS required. In case the recipient is the IFSC Insurance Intermediary Office in respect of the insurance commission, no TDS required under 194D. For the finance company, interest income on the external commercial borrowings or loans, section 195 or 194A, no TDS. Dividend income, no TDS under 194. Commission income on factoring and forfeiting service, again no TDS under 194H. For a finance unit, any interest income on external commercial borrowing or loan, no TDS under 195. Similarly, on dividend, no TDS under 194. On commission income on factoring, forfeiting, no TDS. Fund management entity, professional fee, no TDS under 194J. Broker dealer on dividend income, no TDS under 194. Investment advisor, investment advisory fee, 194J, no TDS. Registered distributor on the distribution fee and commission fee, no TDS under 194H. For the custodian on professional fee or commission fee, no TDS under H or J. Credit rating agency, no TDS under 194J for credit rating fee. For investment banker, on the investment banker fee, no TDS under 194J. Again, on debenture trustee fee with trusteeship fee which is given, no TDS under 194J. International trade finance service, commission income which they generate, no TDS under 194H. Fintech entity on the technical fee, commission, professional, no TDS under J or H. So these are the entities which should be established under IFSC. Only then there will not be any TDS on these income. And these entities have to furnish a statement cum declaration to the payer containing the details of the years in which they are claiming the ATLA. Are we clear? So ATLA, if you see, is the exemption for the IFSC unit. So within the block of 10 years, you can claim in the years the ATLA. So in the years in which the payee is only opting for ATLA, in those years the TDS will not be applicable because their income is exempt. So the statement cum declaration has to be furnished for each of the year. It's not that you will only furnish for the years, okay, these are the years I'll be claiming ATLA. So for each of the years you have to claim furnish the declaration that you are claiming the ATLA, and therefore the payer should not deduct the TDS on the amounts paid to such the payee, and only then the payer will not deduct any TDS. Are we clear? Any questions, any doubts so far?
Ma'am, with respect to this notification, the list which is given, that has to be memorized, or I mean, how it has to be understood as such, there are different kinds of services being covered. So, ideally, by the face of it, you're able to find out which TDS provision gets attracted in the first place. But then, how to, as a payer, and how to, how to memorize things. Is it necessary? How is it? How to go about
See,
with
it
it?
is not necessary. See, for the purpose of, since it's given in your module, we are taking you through. But if you look at it, what you have to only remember is that, for the certain kind of entities which are claiming the deduction under ATLA, if they are receiving any income in the nature of professional fee, commission, brokerage, whatsoever, there will not be any TDS under any of the respective section. This is a limited point that you have to remember.
Okay. And the year in which they have not furnished the declaration. So, in those years, it will apply.
Correct. Yes. In those years, it will be applicable. So you have to
Okay,
only remember
fine.
that whenever the assessee is claiming ATLA, IFSC unit deduction, I don't expect honestly a question on this point. I really do not
Okay.
expect. This is a very, very, like simple point in case, maybe some kind of question on IFSC is asked, and there, you have to just mention one point in the note that the no TDS is required to be deducted because there is this notification. Like,
As a
there could
hidden
be a
adjustment,
comprehensive
it may
question
come.
on ATLA where, there is, let's say, for example, or let's say forget on ATLA. There could be one question where, they have given like payment of professional fee to a unit in IFSC on which TDS is not deducted. So, generally you will disallow the expense, 30%, right? Under
Okay.
40A1.
Okay.
But there you have to write, no, this is made to an IFSC unit, and if in the notes they have given that this IFSC unit has exercised the option for that year under ATLA. So you will say we are assuming that they have furnished the statement cum declaration, and this is the like income which is paid to ATLA unit, which is claiming the ATLA deduction in this particular year. So there was no requirement of TDS, so no disallowance. Because that kind of
Fine.
question
So,
can
this
be
has to
asked.
be highlighted. Okay.
Correct. Yeah. Fine.
Okay. And no effect has to be given to it. Yes. Okay.
Yes. So next is applicability of 197A1D and section 1015.8 to interest paid by IFSC banking units. Now, this is a circular which is issued by the CBDT. What section 197A says that I told you just now. 197A provides the circumstances in which the TDS is not required to be deducted on certain transaction. And 197A 1D provides that the TDS is not required to be deducted by an offshore banking unit from the interest paid on deposits which are made by a non-resident or RNOR, or on the borrowings which are made from a non-resident or RNOR. So in that respect, the offshore banking unit does not have to deduct the TDS on these interest paid. 1015.8 provides that interest, this kind of interest which is provided by RNOR or NR, will not be included in the total income of the non-resident or the RNOR, right? Which is received from the offshore banking unit. Offshore banking unit means what? It is a SEZ, right? It is a kind of a branch of a bank which is located in SEZ. Now, this is for the offshore banking unit. Now, IFSC banking units are also branches of the Indian banks which are located in IFSC. IFSC is different from SEZ. Are we clear? So, if the IFSC units are there, IFSC banking units are there, they also, if they fulfill the criteria of the offshore banking units, they can also qualify. So CBDT has just extended this benefit that the tax is not required to be deducted not only by the offshore banking units, but even by the IFSC banking units, if they are paying the interest on the deposits made by the non-resident or the RMO. So this is just extended to even IFSC banking unit. So in respect of the offshore banking unit, there was no TDS by the offshore banking unit to the deposits paid on the interest paid on the deposits by the NR or RNOR. This is extended even to the IFSC banking unit. That's it. Very simple. Any doubt? Fine. Next one is non-applicability of TDS under 194N on cash withdrawals by the person or class of person as notified by central government. What is 194N? 194N requires the banking company, cooperative bank, or a post office that whenever any person withdraws the cash in excess of 1 CR, 3 CR, right? Then in that particular case, they have to deduct the TDS at the rate of 2%. Right? Now, 194N empowers the central government to issue a notification in consultation with RBI that cases in which 194N will not be applicable. So the central government has notified in consultation with RBI that 194N will not be applicable to the foreign representations duly approved by the Ministry of External Affairs, which include the diplomatic missions, United Nations agencies, international organization, consulate, office of the honorary consulate, which are exempt from paying the taxes in India as per the Diplomatic Relations Act and United Nations Act. So any kind of embassies, any diplomats, any honorary consuls, these are not required to pay any taxes in India. And when they withdraw the cash in excess of 1 CR, 3 CR, there will not be any TDS. Are we clear? Any questions, any doubt up till now? Yes? Okay. Next is person notified by central government on payment to whom no tax is required to be deducted at source. Again, under 197A, as I told you, central government has power to notify the person on whom the TDS will not be applicable or will be applicable at lower rate. So central government has notified through these particular notification that no tax is required to be deducted on the payments received by the Credit Guarantee Fund for Micro and Small Enterprise, National Credit Guarantee Trustee Company Limited, being a company established and wholly financed by the central government for the purpose of operating credit guarantee funds established and wholly financed by the central government. Credit Guarantee Fund established and wholly financed by the central government and managed by the National Credit Guarantee Trust Company. Further, they have also notified that no tax is required to be deducted under Section 194Q by a person who is a buyer in respect of the purchase of goods from a unit in IFSC, where the seller has furnished a statement cum declaration that they have claimed the ATLA for the respective years and he has furnished this declaration for each of the years. Then in that case, the buyer will not be required to deduct any TDS under 194Q. Same thing, what we saw for 194J, 195, 194H, same thing for even 194Q. Any question? So these are very, very simple amendments, like nothing technical. You have to just, remember the pointers for this. That's it. You don't have to get into detail. Like for example, if you look at this particular amendment, which is there for National Credit Guarantee, not important. You can just remember that for Credit Guarantee Fund, there is no TDS. There's this notification. Similarly, 194N doesn't apply to the embassies or consulate offices like that. Are we clear? Any questions, any doubt? Fine. Then again, with respect to the TCS, they have notified certain person on which the TCS will not be applicable. So 206C1H provides the collection of the tax at source by a seller who is receiving the sales consideration in excess of 50 lakh, other than for the export of goods, right? Now, in that case, they have given again the power to the central government to notify that to whom this TCS will not apply or who will not be considered as a buyer. Are we clear? So the central government has notified that again TCS will not be applicable when the buyer is the unit of IFSC, which has furnished a declaration that it is claiming the ATLA for each of the respective years. He has furnished a declaration. In that case, the seller will not collect the TCS for those years. So same thing. What you studied for now, 194Q, even the TCS will not be applicable. Any questions with respect to this entire notification?
So it is all following on the same lines. I mean, the IFSC thing.
Correct.
The statement cum declaration and all of it.
Absolutely.
Okay, it is all connected and
all connected. So see, if you know one thing, you will be like able to write.
generic ones. Okay.
The exam may what you don't need to, like, you have to be, for the CA exams, you have to be smart enough that, like, I remember one of the professor that taught us, FR when I was studying my CA, he told us you should be doing, you should be knowing entire portion, but you should be knowing some portion in entirety. What does that mean? I should be aware of ki kya hai in the module, but certain portion I should be knowing thoroughly.
Yes.
Right? So let's say, for example, if I talk about PGBB, it should be on my tips. Even if I'm sleeping,
You
I
can't
should be
negotiate
knowing.
on that, yes.
Yeah, you can't negotiate on that. So when I'm sleeping, before sleep also, I can, like, talk about PGBP in less than 30 minutes. At least I should be aware about that. At least I should be aware about capital gain. But these notifications, I should be knowing ki, this is there. But exact each point to point, I don't need to remember this. Are we clear?
Too much of hammering is not required here.
Correct. See, the tax is one such subject which is confusing to people because we are not understanding the basics of it. It is confusing at the end of the day. See, even when we practice, there are so many nuances.
Yes,
Like,
it is tough to crack.
very tough to crack. Even practically. Like that day I was having, discussion with my team regarding the slum sale as to how the slum sale question come in the CA final exam versus what we are practically. Practically, there are so many issues in that. And
So many
like,
possibilities.
yeah, from the exam perspective, we have a standard question of slum sale that comes. So people get confused over there. But when you look at practically, it is all the more challenging. So we were doing a slum sale exercise where we saw that, okay, too many things that we have to consider. This is not what we, learned in even CA final days. So the point here is that tax is confusing, but if you, like, are clearer with your basics, you'll be able to, answer it. Are we clear? Yes? Okay. So let's proceed further.
Ma'am,
Provisions to
before
counteract the,
moving on,
yes.
this particular chapter, provisions to counteract, this has been newly introduced, is it? I mean,
This is nothing but your guard chapter. The name is like provisions to counteract
extension
unethical
of
tax. Yeah.
Acha. So this is more of theoretical aspect which is added to the syllabus, this chapter.
Not
Theory is
here.
more, if you look at it.
No, not theoretical. See, you can be asked in a small case study. If you have looked at our revisionary class for the GAR, so what did the GAR provisions, talk about? We discussed some case studies. So those kind of case studies can be expected in the exam where you have to test that whether the GAR applies or not.
Application wise, okay.
Correct, yes. Okay? Yeah. So here they have issued some guidelines for the compounding of offense under the Income Tax Act along with the FAQs on such guidelines. So section 279 provides that any offense which is there under chapter 22 may either before or after the institution of proceedings be compounded by the PCCIT or CCIT or Principal Director General of Income Tax or DGIT. What is compounding? What is compounding of offense? So penalty instead of prosecution. Compounding means that you agree to get penalized, pay some fines, but don't prosecute me. Don't put me in behind bars or don't put me in the prison, right? So you do the settlement basically. So 279 is the chapter or chapter 22 is the prosecution. So if you have committed any kind of offenses which are which can be prosecuted, you can go for compounding before the institution of proceedings, before the prosecutions start, or even after. So explanation to section 279 clarifies that the CBDT has power to issue some orders, instructions or directions with respect to the imposition of the proper composition of the offences. So in exercise of the power of CBDT under 119 and 279, the CBDT has given the guidelines. They have revised the guidelines for compounding of offences under 279. And they have issued the FAQs also, which are applicable for your attempt. So here they have given what is the compounding of offence. So this is a mechanism whereby the defaulter is reprieved of major legal consequences by affording him an opportunity to pay certain sum of money to escape the prosecution. So penalty instead of prosecution. Penalty in lieu of prosecution. Are we clear? So all the offences under the Income Tax Act are compoundable. All the offences, any offence that you have committed for which there is imprisonment, that can be compounded. So these guidelines are applicable from 17th October 2024 and applies to all the compounding applications filed after this date as well as the applications which have already been filed. So the first question they have given is whether revised guidelines are applicable on pending compounding applications. So whatever are filed before 17 October, on these also these are applicable. Answer is yes. So the applicants are not required to file the fresh application or pay the fresh fees. This guidelines will apply even to the earlier application. But in case the applications under earlier guidelines were rejected solely on account of curable defects, fresh applications may also be filed again. So let's say, for example, earlier some applications were filed where there was some typographical error, some kind of error. So they were, rejected and they were given, remanded back that, you cure the defect and again file it. So you can now make a fresh application as per the revised guideline. What are the queryable defect? Which can be, rectified. For example, you have not paid the outstanding tax, interest, penalty or the compounding fees, or you have not filled it in the correct form, or you have mentioned, some incorrect assessment year, financial year, or incorrect section for which you have committed the offense. You have paid short or not paid the charges, right? You have not given a declaration that you are withdrawing all the appeals which are pending. So this now be filed as a revised. But if the application has been rejected in the past on the merits as in you do not qualify for the compounding application, that now cannot be again reconsidered here under the revised guideline because those were rejected on the merits. So let's say, for example, in case the rejection was done only on account of conviction, I had a belief as an income tax officer, I had a belief that you have committed a fraud and I have not examined your case in entirety. So it is not considered on merits. If I've examined your case and I believe that you are lying, you are fraud, you have committed some scams, and then I'm rejecting your compounding application, you cannot reapply. But if I've not looked that into and I just had a conviction, no, you are a fraudster, you are a scamster. So in that case, you can reapply because I had income tax officer not considered on merits. Now, what are the conditions for compounding application? So an application for compounding is made to the jurisdictional PCCIT, CCIT, Principal Director General or Director General of Income Tax. And this can be filed for the offences pertaining to one financial year in case of the assessee, in case of the tax deductor, in case, let's say, he has not deducted the tax, he has not paid the taxes, he has not filed the TDS returns. So he can file the compounding application for a quarter because you have to file the TDS returns for a quarter. And income tax return as an assessee you file for a year, right? So in case of taxpayer, you can file the compounding application pertaining to one financial year and for the TDS deductor for one quarter or for even multiple years or multiple quarters. So if you file for multiple years or multiple quarters, it is considered as a consolidated compounding application. And in case your earlier rejection was done on curable defects or without merits, they were considered. So now you can file a consolidated compounding application for all the previous application. Can you withdraw the compounding application and now file a new one? Applicant can file a single new application or consolidated application after withdrawal of the earlier application. However, such new application shall be treated as a subsequent application and higher compounding rate shall be applicable. Whether the applicant is required to file for all the offences together for which the prosecution has been initiated, no. The applicant may file or apply the compounding application for one or multiple offences in an application. And his application cannot be rejected on the ground that he has not applied for a particular offence for which notice of prosecution has been issued. So it is not that you have to file separate application for all the different offences. Let's say I have not filed a tax return, I have not filed a TDS return. So I don't have to apply the different application. I can do it for one. And is there any limitation as to the number of times a compounding application can be filed? No, there is no limitation. However, the competent authority may reject the application if you are an habitual offender. If you are every year committing the offence, obviously I will not every year, compound your offence. Are we clear? What is the time limit for filing the application? So the compounding application or consolidated compounding application may be filed any time after the offence is committed, irrespective of whether it comes to the notice of department or not. It can also be filed once the prosecution proceedings are launched against you. What is the compounding application fee? The applicant has to deposit an amount which is non-refundable of 25,000 for a single application and 50,000 for a consolidated application. Per application you have to file this. And this is non-refundable fee, but this can be adjusted against the total compounding charges which are decided later on based on what offence you have committed. Are we clear? So this will not be refunded to you, but this can be adjusted against the final compounding fees that will be payable. Are we clear? Any questions so far? Clear? And if your application gets rejected for any reason, this will not be refunded to you, nor you can adjust it in the subsequent application. Whether compounding is allowed, so if the
application wise, specific application wise, it will get adjusted.
Correct. Yes.
Okay.
Now, whether the compounding is allowed if the application for an offence was previously rejected, and whether separate applications need to be filed for more than one application rejected under the previous guidelines. So, an applicant may apply for compounding of offence through a single consolidated application or through single or the consolidated one. Here the question is whether it is allowed if the application for an offence was previously rejected, and if so, whether separate applications need to be filed for more than one application rejected under the previous guidelines. So they are saying, yes, you have to apply for compounding through a single consolidated application if one or more have been rejected earlier. However, the fresh application can only be filed if the rejection was either on the basis of curable defects or the authorities had not considered the merits of the case. If the authorities had rejected on the merits, you can't file a reapplication. Now, all the outstanding tax, interest, penalty, any other sum due relating to the offence for any year or for any quarters in case of TDS, for which the compounding has been sought, has to be paid before making the application. If on the verification by the department, it is found that any demand is outstanding, the same has to be paid by the applicant within 30 days of the intimation by the department or within the time allowed by the department. Application because will only be considered as valid when you have paid all the outstanding demands which are payable by you. Plus, you have to make an undertaking, you have to give an undertaking to the department that you will pay the compounding charges also within the time frame which is given to you. Plus, you will withdraw all the pending appeals which are lying before any of the authority. Now, in case the appeal may be on different grounds, let's say appeal is on disallowance of expenditure, and one appeal is lying against the prosecution which is instituted against you. So the appeal can be on mixed grounds, one of which may relate to the offense what you have done, and one can be for some unrelated issue. The undertaking has to be given for the grounds only which are relating to the offense. Obviously, because if there is some disallowance of expenditure, there is no prosecution for that. So that appeal can continue. I will not withdraw that appeal. So the withdrawal of appeal only has to be regarding the offenses for which you are undergoing the compounding, including any writ petitions which are pending before the High Court or Supreme Court. Are we clear? Any application for compounding of offense, right, for any period for a particular TAN should cover all the defaults constituting the offense under 276B or 276BB in respect of that TAN for such period. Now, you will ask, what is 276B or what is 276BB? These are the prosecution in relation to the defaults of the TDS. So when you fail to pay the TDS or TCS to the account of the central government, there is a prosecution. So there also you can consolidate for all the offenses of TDS and TCS. Are we clear? Now, applicants which do not fulfill any of these conditions or which are not acceptable because the defects are not curable, or because of the curable defects, such as if you have not paid the outstanding amounts, you have not filed in the correct form, you have not filled the correct year, they shall be treated as defective. But you can revive these applications without the additional payment of compounding fee, provided you cure the defect within 1 month from the date of intimation. In case you do not cure the defect, the application will be considered as defective and will be returned back. And any fee that you have paid will not be refunded. And when you file the second application, that will be considered as a fresh application. Now, what offences are compoundable with the approval of the higher authority? So this PCCIT, CCIT, DGIT can compound the offences only with the approval of the CBDT chairman. Which are those offences? In case of an offence for which the applicant has been convicted with an imprisonment for more than 2 years, with or without fine, by a court. There is already an imprisonment given to you by a court for more than 2 years. In that case, the approval of the CBDT chairman will be required. In case of an offence which is committed or which is related to another offence under any other law for which you have been convicted for more than 2 years imprisonment. So in case you have done some criminal act and that is related to this offence also where you have not paid the TDS. And in that offence, there is already an imprisonment given to you for 2 years. Both the offences should be, of course, related. Or let's say I have done some Benami transaction for which there is the offence committed under the Benami Law Act or PMLA Act, Money Laundering Act, whatever. So there I have been convicted by a court for imprisonment of more than 2 years. And here I am evading the income tax. So there is also, this offence which is related to that offence only. So in that case, I will need the approval of chairman before going for compounding. Or if the applicant, as per the information available on the basis of some investigation carried out by the CBI or any central or state agency, has been found to be involved in any anti-national or terrorist activity, then in that case, the commissioners will consult with that agency, seek their inputs regarding, why this assessee or this applicant is, being examined under that particular agency. And based on that, it will decide on the through the approval of the CBDT chairman that whether it is a deserving case for the compounding. Or in case the applicant, when it is proved that the applicant has not himself committed some tax evasion, but has facilitated the tax evasion through mechanisms such as use of, such as providing or creating these, sham entities for money laundering, generation of bogus invoice. Like, there are these persons who take commission and help you generate the bogus invoice without the actual business, or they provide you accommodating entries. So in those cases, the person which are helping that, if they are also now, charged for prosecution, any kind of compounding application will be undertaken only after the approval of the CBDT chairman. Or if your offense is directly related to any offense under the black money law, prohibition of Benami transaction, property transaction, as I said, in that case also you will be required to take the approval of the CBDT chairman. And the last one is in case of an offense under section 275A and 275B. What is 275A and 275B? So 275A and 275B is in respect of the search provisions, where you have violated the provisions of the search when the search proceedings are carried on you. In that particular case, this will be only compounded with the approval of the CBDT chairman. Are we clear? Any questions so far? So it is not that, these offenses will not be compounded. These will be compounded, but only with the approval of the chairman of CBDT. As I said, the authority to compound is usually with the PCCIT, CCIT, Principal Director General, or DGIT, who are the jurisdictional authority. However, if you have committed an offense which are of these nature, then the approval of the CBDT chairman will be required. Are we clear? And who is the jurisdictional officer in case you have not paid the TDS, TCS to the government? In case of resident or non-resident payee or collectee, then the jurisdiction lies with more than one jurisdictional charge. Because, you can have like the payees in different jurisdiction. In such a case, the PCCIT or these commissioners which are there in whose jurisdiction compounding application has been filed will be considered as the jurisdictional authority. And in case you file in more than one jurisdiction, then the competent authority will be the jurisdictional authority where the quantum of the TDS default is higher and all the applications will be forwarded to that competent authority. And in case the applicant files compounding application for offences committed under 276B or 276BB, which is for non-payment of TDS CCS in respect of 2 or more TANs, which are falling in 2 or more jurisdiction, then the jurisdictional authority where the quantum of TDS is higher will be considered as the competent authority and all the applications will go there. Now, what is the compounding procedure? First, the competent authority will take the report from the AO or the assistant commissioner or deputy director, right? And then if they have to find out whether the compounding application is acceptable or not. Only when it is not found, let's say, acceptable, then they will dispose of the application through a proper order within 2 months from the receipt of the application. In case they find it acceptable, then they will intimate it to the applicant accordingly that these are the compounding charges payable. It's not a fixed fee. That 25 and 50,000 that you saw, that was a compounding charges that you are paying. But what is the actually compounding fees that you have to pay to avoid the prosecution? That will be determined on case-to-case basis. And that 25,000 will be adjusted against that amount. So the competent authority, based on the facts, will determine what is the amount payable along with the compounding charges payable, any other pending liabilities demand that you have not paid, and such intimation will be made within 2 months from the date of receipt of your application. And then they will give you 1 month to pay this amount. You can ask for the extension of the time to pay the amount, and in the exceptional circumstances, they may extend it up to the period of 6 months. They can extend it up to 12 months only with the prior approval of the principal chief commissioner of the income tax of that region. They can extend up to 24 months only when the CBDT chairman or a CBDT member gives that authorization. But no extension shall be allowed beyond the 24 months. And in case you don't pay the compounding charge, the application will be rejected and then the prosecution proceedings will be initiated if they have not been already. And the complaint shall be served on the prosecution. Are we clear? Any questions so far? Fine. What is the time to pass the compounding order? When you pay all the fees, the competent authority will pass the compounding order within 1 month of when you pay the fee. So any case, any penalties are pending, such proceedings will be concluded and the compounding order will be issued. And if there are any particularly NRI taxpayers, so taxpayers who are particularly NRI avoid opting for compounding due to a misconception that it constitutes an admission of offense. It's not that, that you have admitted the offense. So, NRIs have that fear, like if we pay the compounding fees, internationally, we may not be getting the visas and all of that. So, it is directed by the CBDT that the competent authority in respect of the NRI taxpayers will include in the compounding order this statement that this compounding order is intended to just resolve the offense and should not be construed that the particular applicant has accepted this offense. So compounding doesn't mean that I'm accepting what I've done. It just means that I just want to resolve the dispute. Are we clear? Any questions so far? Yes, students, any questions, any doubt? Yes, is it understood fully? Okay. Now, next is whether the time for payment of compounding charges may be extended beyond 24 months. As I said, no. So, beyond 24 months is not allowed. Up to 24 also only from the permission of the CBDT chairman. And if you have not paid, then the application shall be rejected, followed by the prosecution proceedings. However, you can file a new application for the same particular, which will be treated as a subsequent application for the purpose of determining compounding charge. Now, the payment period for compounding charges, they have said that is extended up to 24 months. So, for pending applications, where the payment was made before the issue of these revised guidelines, but the payment was not made, how will the 24 months be calculated? So, for the applications which were pending, the CBDT is saying that wherein the compounding charges were not paid until that time which is allowed, or where the time had not lapsed, the 24 months will commence from the October 2024. And this will require the approval of the relevant authorities. Like whether principal commissioner will authorize if it is beyond 12 months, if it is beyond 24 months, the CBDT chairman will authorize. And next question is, are extension for payment of compounding charges subject to any interest or additional charge? The answer is no. Even if you get extension, there is no additional interest or no additional charge which has to be levied. Are we clear? Any question? Now, what are the compounding charges? So, for the purpose of computing the compounding charges, the word tax means tax including the surcharge and cess. Interest will not be included in tax for the purpose of compounding charge. So, this has to be computed for each offense, and where there are subsequent application filed, that will be considered as separate application. So, if it is for the subsequent offense, then in that particular case, it will be 1.2 times, next 1.4 times of the earlier fee, then again 1.6 times of the earlier compounding charge. And if in the subsequent application includes an offense which had not been disclosed in the earlier application, the compounding shall be computed, or the compounding charges shall be computed only as per the charges given in these guidelines. It will not be the case that, for the earlier offense, now I will, charge additional fee. Are we clear? Any questions, any doubt? So, in case the application is made beyond the 12 months from the month on which the prosecution complaint is filed, the compounding charges will be increased by 50%. The compounding charges will get increased by 50%. Clear? Any questions that do you have? Is it, getting understood by you? Yes? Yes or no, students? Shall we proceed further? Okay. Now, they are saying, how shall the compounding charges be calculated for applications pending before the issuance of these guidelines? Prior to guideline, there were, applications, some pending. So how will new charges be calculated? So they are saying that the compounding charges for the pending application are subject to redetermination as per the revised guideline. All pending applications, whether for single or multiple years, shall be treated as first compounding application. It will not be considered as subsequent, because for subsequent you have 1.2x of the earlier amount, right? And the compounding charge shall be recomputed for each offense disclosed in the application. Then they have a FAQ. If a new consolidated application includes a year for which application was filed earlier and then withdrawn, whether partial compounding charges paid for such year for which is withdrawn adjusted against the total compounding charges towards the consolidated application. Meaning, if you had already paid earlier but you had withdrawn the application, now can you adjust that charge against the new application? Answer is no. So whatever partial compounding charges you had paid for that particular application which is withdrawn can be adjusted in the new application only towards the offense and the particular year for which payment was made, not against the new compounding fee for the another offense. Are we clear? An applicant had filed the compounding application under earlier guidelines, 2 of which were rejected on account of curable defects, 2 were compounded and 3 are pending as on the issuance of this guideline. How should the applicant file a compounding application after the issuance of the new guideline, and how shall the new application be treated? So, answer to that is no action is pending for the applications which have been compounded. A consolidated application may be filed for all the applications which were rejected on account of curable defects, and no fresh application is required to be filed for pending application. All the pending application, whether for single or multiple years or quarters, shall be treated as first compounding application, and compounding charge shall be recomputed for each offense disclosed in the application. The fresh consolidated application for rejected applications earlier will be considered as second application. Accordingly, the application filed after issuance of these guidelines shall be treated as subsequent application, and compounding charge shall be recomputed for such offense disclosed in the application. Meaning, all the pending applications which are there, that you don't need to file a fresh application. That will be considered as first application. Any rejected on curable defects now will be considered as second application, for which the charge will be 1.2 of the earlier first compounding charge. And any new applications that you will file, that will also be considered as subsequent application. Clear? How the rate of compounding charge will be determined in subsequent application? So as I said earlier also, the rate of compounding charge is based on sequence of application as well as offense applied for. If a subsequent application includes an offense which has already been included in the first application, it shall be liable for a higher rate, that is 1.2 times, 1.4 times, 1.6 times and so on, because you are repeatedly committing the same offense. Irrespective of the fact that the offense and the year of the offense are same in subsequent application and the earlier application was rejected or pending or even compounded. So it doesn't matter if your earlier application got rejected or is still pending or it has got compounded, the fees will be 1.2 of the earlier fees. Are we clear? However, if the subsequent application includes the offense which were not included in the earlier compounding application and the offense has been applied for the first time, then the compounding application will not be 1.2x. It is only when you are committing the same offense, it will be 1.2, 1.4, 1.6 like. So if you see like this, an applicant has filed different applications on different dates to compound different offenses. So on 2021, he has compounded offenses under 276 fee, right? Again, in October 2022, he has compounded the offense under 276C. So now this is not the subsequent application. Here it is not applicable, right? This August 2023, this was rejected. Nothing then. In September 2024, there is a pending application on 276D. Now, this is the first application. This is the first application. No fresh application required under the revised guidelines. All these were done earlier. This is compounded, this is closed. This is rejected, this is closed. This is pending. Now, no fresh application will be required after October. This will be considered as the first compounding. And here the rate will be the normal rate for the compounding. In November 2024, he filed a single application for all the earlier applications which are rejected for 276B, which is basically this one. This will be considered as the second offense or second application. So, in the application dated this 15th January 2021 and 18th August 2023, there was the same issue which was there. Right? So, this is considered as second time, and now, therefore, your compounding fee will be 1.2 times. So, the applicant has opted for compounding for 276B in 2021. Again in 2023 and now again in 2024, which is the third time. And this is his third application. Accordingly, the compounding charge at 1.4 times, not 1.2, 1.4 times of the normal rate should apply. However, since the both applications were filed under the previous guidelines, they were not filed in the current guidelines. They were filed in the previous guidelines. The two applications earlier, one which was rejected and one where compounding was done. Both the applications will be considered as first application. Are you getting it? So even though he has compounded 276B once, this is twice, and this is coming third time. So it should be ideally 1.4x, the compounding rate. But these both applications were prior to the guidelines and will be considered as the first application. The applications prior to the guidelines are considered as first application. So this time that he is filing will now be considered as second application, and second application rate is 1.2. Now when he is doing again in December for 276B, this is now going to be considered as third, and this will be 1.4 times. Ideally, this should have been 1.6 times. But the earlier applications which are filed in the earlier guidelines will be considered as first. Now what he has committed second, and then this third. Are we clear? And next is for 276C. So 276C, he has again earlier filed in the earlier application. So that was the first time. This will be the second. And this is 275A. This is for the first time he has applied. So this will be at the normal rate. Are we clear? Is this understood well? Yes?
Ma'am, the 276C, that has been with respect to before the issuance of guidelines, right?
Correct. So that is the first application. This will
So
be the second.
that
So it is
first
now
application,
1.2.
it will be taken to 1.2 times. Okay.
Next question is whether the compounding application can be filed after the launch of prosecution. Yes, that can be. But if you do it after the 12 months of the prosecution launch, the fee will be increased by 50% of the fees which are given in the guidelines. Clear? Again, this illustration is given that assessee has made the TDS default of 10 lakhs. For 3 months during financial year 1920. The prosecution has been launched on 1/4/2022 under section 276B of the Act. Normal compounding charges, let's say, are 45,000. This is not given under that. It is based on the facts of this case that the officer has determined. It is 45,000. So this is assumed. Now let's say in 2022 there was case 1 where it was pending as on 17th October. where the time was less than 12 months, he had filed the application. So he had paid the normal compounding charges 45,000. This is pending. Case 2 is 31st October 2024. He has filed under the revised guidelines after more than 12 months. So this will be increased by 50% of 45,000, which will be 67,500. Let's consider the scenario 2. The first application was rejected. We had filed within less than 12 months, but this was rejected. And now he has filed the revised application under the revised guidelines, which is after the 12 months. Now, since the first application was rejected earlier, here, this is under the revised guideline. It will be considered 1.2 times of the normal compounding charges because this is a second application on the same offense. And plus this will get increased by 50% also. So 1.2 of 45,000 for the first offense and plus 50%. So this is what will be the compounding charge that will be leviable to him. Are we clear? Last point, co-accused and abettor. So offenses by the companies and offenses by the HUF. So where the offenses are committed by company or HUF, an application for compounding may be filed either separately or co-jointly by the main accused, that is the company or HUF, and any of the directors or the karta or co-partners which are deemed to be guilty of offense under 278B or 278C. Now, what is 278B and 278C? 278B and 278C are basically the offenses which are committed by the companies or the HUF. So, any offense which is committed by the company under 278B, where there is company which is committing some kind of offense. So, it will be charged under 278B, and for the HUF, it will be under 278C. And in case of offenses by a company or HUF, the main accused or the co-accused can also apply separately or co-jointly. And on the payment of compounding charges by any one of them, either separately or jointly, the competent authority will only compound the offense against both the company as well as the director or the HUF karta. Are we clear? So they can apply under the revised guidelines. Yes.
In the previous illustration, I would want to ask regarding case 3, can you explain 1.2 calculation again? Because first application has been rejected.
Correct. So he has committed the same offense again. See, first application rejected, same offense against. This is a subsequent offense. This is the first offense. This is second. So it will be 1.2 times. And now he has filed after 12 months. So it will be increased by?
It will be 50% increase. Okay. Fine.
Now here the question is whether the compounding application of the co-applicant was rejected earlier on the ground that the company had not filed for the compounding. Whether both the company and the director will be eligible to file again? The answer is yes. So if the case was not rejected on merit, in that case, the director will be eligible to file the compounding application again with the company or separately, and this will be treated as a subsequent application. Similarly, where the compounding application of the company was rejected on the ground that director has not filed for the compounding, or he has not given an undertaking that the applicant will be eligible for filing again. So, in that particular case, can they file now under the revised guideline? Yes, they can. Because this application was not rejected on merit, this will be considered as a subsequent application and they can file again. If it was pending, whether they are required to file a fresh application, answer is no. There is no fresh application required if there is already a pending application. If the application is filed by the company or the director or both of them, whether separate compounding fee shall be payable by them, the answer is no. There will be one compounding fee for both, irrespective of the fact that whether they have filed a separate application or whether they have co-jointly filed, the compounding charges for the offense shall be payable together. And once such payment is made, the offense will get compounded. So whether any person other than the main accused or co-accused can file the compounding application for compounding of offense of company or HUF, answer is no. Only the company and its director can file, who is accused. Can the director furnish the undertaking for withdrawal of the appeal on behalf of the company? Answer is no. The director cannot furnish the undertaking for withdrawal of appeal on behalf of the company. That undertaking has to be furnished by the company or HUF along with the application. Are we clear? Now, if the application has been filed only by the company or only by the director, in such case against whom the compounding order shall be passed? The compounding order shall be passed in the name of the person who has applied for compounding. If the director has applied, then again in the name of director. If the company has applied, in the name of the company. Are we clear? Any questions, any doubt? Fine. So we'll stop. Yes.
Yes, thank you so much for today's session, ma'am. And ma'am, as discussed with you earlier, actually I had a word with the BOS faculty, one of the BOS faculty over the phone. As per the telephonic conversation, she said that the Saransh, the updated Saransh, should be out in the first week of July. So even I had discussed with you in earlier session when it comes to tags, the updated ones, when it will be available on the portal. So do you have any idea? I want to seek confirmation over this, that whether it has been released or what is it? What is the status of it?
Honestly, I'm not sure about it.
Acha, so shall I connect with the concerned person over the number also, which is provided on BOS portal, on the portal?
You can
Yes, fine.
talk to them directly only.
Okay, for some other purpose, I had a word with them earlier. So
Okay.
I just want to confirm whether it is out or not. So fine, I'll do the
Yeah, you can talk to
same.
them only.
Okay, fine. Okay, fine.
Okay.
Yes, thank you so much.
Thank you, everybody. Let's meet. I think the next session is on Thursday, right?
Thursday, yes.
Yeah. So we'll have the last class on Thursday where we'll cover the remaining statutory update and the judicial update. Thank you so much.
Thank you, ma'am.
Yes.